2018, these 10 types of mutual funds will be earning big. In view of the low interest rates on small savings schemes, falling short of gold and poor real estate returns, most investors moved to the stock market in 2017. The stock market also favors investors' expectations. However, if something goes wrong with the investors, they are mutual funds, which gave a strong return. Large caps category gave 30.12%, mid caps up by 39.76%, SLIP cap 52.49% and multi cap returned 33.36%. It is expected that in the new year 2018, glow of mutual funds will remain intact. Given the needs of all types of investors, today we are talking about 10 mutual funds, of which you can select something according to your needs and risk-taking ability. Through them in the long term, you can expect good returns in the new year too. 1. Large cap funds. These come with large market-capped blue-chip companies. If you do not want to take more risks in mutual funds and also invest in equity MF, then this is a good option for you. These funds have given returns of more than 30% in 2017. 2. Mid-caps funds. Such funds have a higher risk, but they also return higher returns. These funds invest in small and emerging companies, from which you can get a lot of returns. In 2017, they received a return of almost 40%. 3. Flexi cap funds. These funds are designed in such a way that it does not depend on the market cap of any company. This is the reason why their fund managers have used the best opportunities for emerging market fluctuations from time to time. There are also opportunities for diversification in such funds. For diversified funds, new investors afraid of taking risks in the equity market can invest in diversified funds. The managers of these funds invest in different sectors, thereby reducing the risk of investment. Investors who have less risk or no risk can invest their money in diversified funds. 5. Balanced funds. Balanced fund equity and debt mix. They are also called hybrid funds, in which the stocks and bonds mix in a ratio of 50-50. These funds are for investors who do not want to take more risk. 6. Debt funds. Debt funds have less risk. Liquid funds have the lowest risk in them. With debt funds, you get returns of 7-9%, depending on your asset mix, time and risk. 7. Liquid funds. Liquid funds invest in securities, which have maturity up to 91 days. The risk in these funds is not equal to nil. There is no lock-in period of this fund. Therefore, they can be withdrawn anytime. However, returns from such funds are not guaranteed because their performance depends on the market. 8. Asset allocation funds. These funds are primarily made up of equity, debt and cash equivalents, which are invested in many types of securities. For investors who are unable to make proper allocation of their funds from time to time, they are good funds. 9. Sector funds. These funds invest in stocks of certain sectors, such as banking sector, telecom sector, technology sector, etc. It is good for those investments that are more optimistic about a particular sector, although these funds are risky. 10. Thematic funds. These funds come from diversification in investment. However, these funds are risky as companies are selected from different sectors for investment on a common theme basis. For example, if you talk about infra fund, then oil and gas, steel, metal and mining.
Like, share, subscribe.